Hi there, in this video I will walk you through an SPX put butterfly trade and how it behaves in a tight, range-bound market environment. My name is Gery and I'm the Chief Options Expert at TanukiTrade. The idea behind this position was to use a very flat delta negative vega put butterfly below the HVL line, the high volatility level, positioned around major put support levels. The goal was not to build a crash protection, but controlled exposure with limited downside risk and the potential to act as a hedge as time decay accelerates. As the market continued to move sideways between key levels, the structure gradually opened up, allowing me to scale out part of the position and lock in gains while keeping a portion for further time decay. The key takeaway here is how slow-moving flat butterflies can work in range-bound markets, but require monitoring as volatility and gamma levels shift. So let's get into the live position management recording. In this video, I would like to show you a position that I opened yesterday, but yesterday I had no time to record this session. So this was the opening candle here, because I thought that the market might bounce back from the 50-day moving average. And this was also a nice technical support around here, this area. Obviously, I was wrong because the market gapped down today. And right now we are sitting around the 6,800 put support, which you know that can act as a put support and can also create a violent down move as well. So right now what I would like to show you is the position that I opened yesterday, because when the VIX is rising, the volatility is rising, and when IV or implied volatility is high, you see the pricing skew also goes high. Here, the pricing skew, put pricing skew, you can open credit put butterflies for 50 and 60 strike difference. Here you see the strike difference is 50, here you see it's 60. So what we can see in here is that this is a credit butterfly, so if the market stays around this level, I have nothing to lose. If it goes down, the risk is shifted here. So you see that I only have risk on the downside. And if the market gyrates around this area or does not move lower than 6660, which is around this area somewhere in here, then this position is fine. So actually the break even, the lower break even is 6610. So the lower break-even would be around these candles. Right now, what I'm showing you is the normal monthly expiration GEX, and 6,800 is the next put support. And these are the following put walls, 6,700 and so on. And this position has an expiration of March 3, because that was the only possible combination with 50 and 60 wide spreads that also paid a nice credit, or not nice credit, but enough credit to hedge for the commissions and cover the commissions as well. So actually what you can also see in here, that this is the current market price, and this is a pretty flat delta position with positive theta and obviously negative vega. So if implied volatility drops, so if IVR and IVX drops, then this one can open up very slowly. This is a very slow, very flat delta position, but this can act as a hedge later on in a couple of, maybe a week or 2 weeks later, when delta becomes negative because of the time decay. Then this position can act as a potential hedge for upside positions. So this is what I opened yesterday, and here's the screenshot of the fill. What you also can see is the timing of the screenshot, and it was filled for 10 cents each. So this is how the position is currently doing. I will continue from here. It's the 17th of February, and as you can see, the market is not moving anywhere from the start of the year. We are in a very tight range between 6,800 and 7,000. We are zigzagging back and forth, and I opened the position here. Right now we are here above the 6,800 put support or highest put GEX level, below the HVL. And the position started to open up a little bit. That's why I decided to close at least half of the position for 45 cents. And with time, it is becoming even more and more negative data, but it's still very, very flat. So if we jump ahead in time and we see that a couple of days before expiration, it becomes really negative in terms of data and really can act as a protection, as a real hedge. But as I always say, this is not a crash protection. This is not a crash protection in terms of the market moving down, because at least this is a risk here, and the position becomes very negative data at the very, very last days until expiration. So this is what I changed in the position. I closed half of it. I scaled out from half of the position. And right now we are just above the 6,800 put support. If this breaks, the market can move further down, especially because we are under HVL, which is the high volatility level. And if we are below HVL, volatility tends to pick up. So we have to watch these levels carefully. And if it's breaking, then I need to adjust the position or just, close down the position. That's also a possibility all the time. And if I see the current price right now, it's around 40, 35, 40 credit for every single butterfly. So if the market stays around this area, I will make $65. If it's going down and I can still increase the negative delta with time, the charm effect, then it can make even more money. But, it's a very lucky situation if the market drops or crashes just right before the expiration. If you look at the expiration, it's the 3rd of March. And if we are jumping ahead to the 3rd of March, that's actually the delta curve or the T+0 curve at expiration day, on the day of expiration. So if the market crashes exactly on the day of expiration, I can make around this area, or if I'm really, really lucky, I can make around 2,500 or something like that. But that's extremely lucky. The general or very realistic expectation is a maximum of $500 in here. That's currently or usually the maximum I would expect from a butterfly like that, but more in the range of like a couple hundred or something like that if you are lucky. So never try to shoot for this, because that's an illusion. So this is how the position looks like right now. This is the current state. I will continue from here. It's Thursday, and as we can see from the daily chart, this bounce from the 6,800 was pretty short-lived, because the market bounced back from the HVL after 2 days of up move, and right now it's falling again. This is a pretty unstable environment below the HVL, and as you can tell, that nothing really is happening since the start of the year. Pretty sideways movement, choppy market. It's hard to trade in here. And since I am traveling next week, I decided to close down the other half of the position for 55 cents. And here you can see the screenshot of my fill, 55-cent credit on the Trader Live account. So all in all, this created a $120 profit, and the whole position is closed now. So I hope you gained some insights from this position. If you have any questions, just let me know. Thank you for your attention. Take care. Bye. Thanks for watching. If you haven't yet, please subscribe and check out our other videos. You can always find us at the links in the description. Trade safe out there.